All right, so we've looked now at the general understanding of accounting, and we're going to dive into the chapter now. So here we're going to start by talking about financial information and the users of this. So financial information is really the documents that report financial information about an entity to persons inside and outside the business. So there's various reports that can be made, and the most common are financial statements, as it says here. So a balance sheet, income statement, statement of owner's equity, and a cash flow statement are all the financial statements that we're going to learn about. Now, financial information is used by various users. And the first step in this flow that you'll see in this diagram here is for people to make decisions. So someone in a company or in a business is going to make a decision to do some sort of activity. So they will make a decision. Because of that, a business transaction will occur. So they've decided to buy supplies, and then they go and they actually have that transaction where the supplies is purchased. Or they decide to take on a contract and do some work for a customer. They do those services, provide the goods, and bill the customer. That would be another transaction that's occurring. Eventually collecting cash from a customer, again, another transaction. So these happen all throughout the year, and they build into financial information. So it'll go through the bookkeeping, all of the transactions, and it becomes financial information. From this information is then used by management to prepare reports and to show the results of the business operations. So as I said, the most common will be financial statements, but many different reports prepared by different businesses for their specific needs. From there, users will look at these reports and they will use it to make more decisions. So that's the biggest thing that financial information is used for. It is used to make decisions. Various decisions and information like, is our business making a profit? If not, they would decide what changes to be made. Should we hire more staff? Can we afford to purchase this equipment? Do we have the cash? Do we need a loan? How can we do that? So that is kind of the flow of information. It is used to make decisions. There are a lot of users who use that financial or accounting information to make decisions. They're broken out into two categories, and the first here is lumped as business users and internal users. So these are users. Examples, sorry about that. Examples here would be an owner of a business. Oh man, sorry you guys. The technology is fighting with me. Owners, management, top management of a company. The CFO, so the chief financial officer, the controller. So these internal users are individuals who work for a company who have access to all of the accounting information. So they are able to look at the details of all those transactions that occurred. The other group, and that kind of covers the rest of these, are external users. So they are outside of the company, typically, and they do not have access to all of that detailed information. They only have available to them any information that has been made public or that's been specifically provided to them. So we'll go through a couple of these examples. Creditors is one. So creditors are anyone who provides financing or lending to a business. The best example here is a bank. If a company needs money, they would go to the bank and ask for that. So creditors are going to use financial and accounting information to look at how well that company is doing. So typically they're going to look at the financial statements, see how the company has performed over the last few years, and then make a prediction of how well they'll do in the future and decide if that company is going to be able to repay the loan. If they think they will be able to repay it, the bank or other creditors will give that lending. If they don't think the company is doing well enough and they won't be able to repay, they would decide not to give a loan likely. Investors, these are people or individuals, entities who are buying shares of the company. So they're investing in order to make a return, make money themselves. They would look at financial and accounting information to decide, number one, should they buy those shares? Or is that a good business to invest in? So they would likely look at the financial statements of multiple companies and compare them, see who's doing the best and who they think will be the best company to invest in order to make money. Then there's other various users. You can see here the government. So they're going to be looking at financial information from businesses so they know how much taxes they need to pay. You can see there's so many here, but there's also this other. There is various users, and they are really relying on accounting information to be able to make good decisions. So how do we ensure, yes, we can have these transactions, get them recorded, but how do the users know for sure that the information in those reports is accurate and is something they can use to make decisions? Oh, I'm ahead of myself. First, we're going to look at the two types of accounting that there is, I guess. So keep going through the users a bit more first. So financial accounting is the first that we'll look at. And that really looks at what has happened in the past. So they're looking at the transactions, making sure they're recorded properly and that the financial statements are prepared with the right standards and they are accurate. So it looks at how well the company's doing, and they can use that now to predict in the future how well they think the company will do. So the users you can see here are both internal users, but also some external as well. So both types of users will use financial accounting. Internally, those owners and management are again going to look at how well the company's doing, what changes do they need to make, are they growing, are they doing worse than prior years, that type of thing. Investors will ask the questions like, should I invest in the business? Am I getting an adequate return? Creditors will look at statements and decide, is this company doing well enough that we can lend the money and we will get repaid? So financial accounting, what has happened, and using that information to predict the future. Managerial accounting is really used by internal users. And they're using this accounting to make decisions about how to manage, how to run that company. So the operational decisions, as you can see here. These would be things like, is our profit line or is the product line profitable? So that YouTube video I showed to start, they looked at the markers. Is that a profitable product line for the company to either start or if they're already doing it to maintain? Are we doing well enough that we could expand and open a new branch? Or when should we order more inventory? Do we have enough now? Are we getting low and it's possible we should sell out? So when should we order more? So managerial accounting is the managing of those operations, so it is used by internal users. So as I said, lots of users, and we need to know how they can decide if that information is accurate. And accountants have to follow a set of rules. They can't just record transactions in any way that they want. There's rules that need to be followed. And this is referred to as generally accepted accounting principles, or shortened into GAAP. So a good way to think of this is GAAP is to accounting like laws are to lawyers. So accountants need to follow GAAP and the standards, and those are the rules they need to follow. just like lawyers have laws in place that they have to follow. Countries are able to set their own GAAP and this more specific standards within them. So in Canada, there's a few different ones, and the two most common that we will look at throughout this course are ASPE and IFRS. So the first one, ASPE, as you can see here, that stands for Accounting Standards for Private Enterprises. So these standards are available for any non-public companies. It says small to medium, but that's just typically a small to medium company would be non-public. They are available to any non-public company that exists. The second set of standards are the International Financial Reporting Standards, or IFRS. And as you can already see from this slide, accountants make or use a lot of acronyms. So we'll go through what they really mean, but if two accountants were talking to each other, you would hear them say ASPE or IFRS, not the full words. So International Financial Reporting Standards is allowed in Canada, but it is internationally recognized, so it's globally recognized. And this is required for all publicly traded companies. So companies whose shares are available on stock exchanges like the Toronto Stock Exchange, New York Stock Exchange, any of those companies that are publicly traded, they must use IFRS. And the reason for that is because they are widely traded. So anyone in the world could purchase shares off the Toronto Stock Exchange. And because of that, their users, those investors, the users of the statements need to be able to compare multiple companies across different countries. So for example, if there was an investor in France who wanted to buy shares of some sort of company to make more money, they would want to possibly buy shares from a company in the US. Maybe they're also looking at shares for a company in France. So two different countries, but if they're both publicly traded, they would both be using IFRS. So when that investor is comparing the two statements, they're following the same accounting standards, so they are comparable. That investor will be able to look at both of them. They're using the same standards, they can make a good decision of which company is best to invest in. IFRS is a bit more complex than ASPE. So IFRS is required for public companies, but a non-public company, a private company, could choose to use IFRS. But because it's more complex, they typically would use ASPE. This ASPE is by far the more common standard that I've seen while I was working in Red Deer. I only actually worked on one company where it was a public company and they used IFRS. So if you're in Red Deer, there's far less public companies. You're likely to see ASPE being used. Whereas if you go to Toronto or Calgary or Edmonton even, there's going to be more public companies, so IFRS would be a bit more common. Okay. So these standards are in place for accountants to follow, but it's also important for them to have a high sense of ethics to actually follow the rules that are in place. Excuse me, sorry. So there are sometimes pressure on accountants from owners to falsify the statements. So for example, say that an owner needed a loan from a bank in order to keep their company going. They needed that loan, they wanted to expand, but they needed extra money. If their statements weren't looking quite as good as they hoped, or their performance wasn't the best in the last year, they may try and pressure the accountant to make the statement looks better. So to falsify the information, maybe make the revenues seem higher. But an accountant needs that strong sense of ethics. They are required to follow the rules regardless of what pressures are on them. There are standards for CPAs. So it's called the Rules of Professional Conduct. And they go over these points here. So they talk about confidentiality that's required. Important one here, refusal to be associated with false or misleading information. And if a CPA doesn't meet these rules, they would lose their designation. All right, so that's just a quick look at the users. Remember, financial information must be accurate because there are so many users who are making decisions based on that information.